We need to go back to 1967 for a moment. A small group of investors in Cleveland, Ohio, were sitting around a table staring at a legal document. This document would fundamentally change how ordinary people could own real estate forever. Before this moment, if you wanted to invest in commercial property, you needed to be wealthy. You needed deep connections and millions of dollars just to get a seat at the table. But these investors discovered a legal structure that would let average people own pieces of shopping centers and office buildings. They could own apartment complexes for the price of a single stock share. The wealthy fought against this legislation for years. They understood the power of this vehicle and tried to keep it for themselves. By the time we finish, you will understand the exact mathematical framework used to generate this wealth. You will see why 3 specific real estate investment trusts are positioned to change your financial future. We will look at how $10,000 could potentially turn into a massive portfolio over the next 2 decades. In 1960, President Eisenhower signed the Real Estate Investment Trust Act. It allowed companies that owned real estate to pass income directly to shareholders without corporate taxes. The condition was that they must distribute at least 90% of their taxable income as dividends. Wealthy families had been using private real estate trusts since the 1800s to build empires. The Act of 1960 was supposed to democratize this wealth-building tool for everyone. But for 20 years, Wall Street tried to bury these simple vehicles to protect their own complex business models. Then a massive banking crisis in the late 80s changed the industry forever. Property values collapsed, and the government found itself holding billions in distressed assets. Institutional investors saw an opportunity to buy premium real estate at pennies on the dollar. They used the real estate investment trust structure to attract capital and rebuild. The people who got in early saw returns that seem almost impossible today. Some trusts from that era delivered total returns exceeding 2,000% over 30 years. That means $10,000 would have become over $200,000 plus monthly income. But building generational wealth requires choosing the right sectors with genuine advantages. Imagine you are considering opening a franchise restaurant today. A fast food burger chain is dependent on foot traffic and the strength of the economy. If the economy struggles, people cook at home, and your success is outside of your control. Now consider a medical office building right next to a major hospital. Your tenants are doctor practices and therapy clinics with very long-term leases. They spend fortunes on medical equipment and cannot easily move down the street. Patients come to them regardless of economic conditions because health is not optional. Most investors chase high dividend yields without considering the quality of these tenants. This is where most people go wrong and why they never reach their goals. The big pension funds and endowments love high-quality real estate investment trusts. They have been quietly accumulating positions for decades while telling you it is too complicated. The truth is that you only need to understand dividend growth and the quality of the property. Wall Street wants you to be scared of short-term interest rate movements. They want you to sell your shares to them at a discount when the headlines are scary. But the most important factor is the growth of rental income and the stability of the cash flow. Let us look at our first pillar of stability, Realty Income Corporation. Their ticker symbol is simply the letter O, which stands for monthly dividends. They have made over 650 consecutive monthly dividend payments since 1994. They have increased that dividend over 120 times in the last 30 years. They own over 15,000 properties across the United States and Europe. They focus on necessity-based retailers like grocery stores and pharmacies. Think about companies like Walgreens, 7-Eleven, and Dollar General. You will not stop buying groceries or medicine because the stock market dropped. Even better, they use what are called triple net leases for their tenants. This means the tenant pays for property taxes, insurance, and all maintenance costs. The company simply collects the rent checks without worrying about repairs or rising taxes. If you invest $10,000 today, you start with a yield of about 5.5%. That is roughly $45 per month in passive income, right from the start. After 20 years, your monthly income could more than double without you adding another penny. But this company is just the bedrock foundation of our strategy. To accelerate wealth building, we need the second company, Prologis, ticker symbol P. O. D. They are the largest industrial real estate company in the entire world. They own over 1 billion square feet of logistics facilities across 19 countries. Every single thing you order online has to be stored somewhere before it reaches your door. That somewhere is increasingly a facility owned by this company. Traditional retailers like Walmart and Home Depot are racing to build their own delivery networks. They need modern warehouses close to major cities where land is extremely limited. Zoning approvals take years, and construction costs have skyrocketed recently. This creates a situation where supply is limited, but demand is growing every day. This company can raise rents year after year because their tenants have nowhere else to go. Their dividend has grown at approximately 12% annually over the last decade. The share price appreciation alone has historically outperformed the broader market. However, higher growth often comes with higher short-term volatility. This is why the stability of your bedrock assets is so important to help you hold. Our third pillar represents the infrastructure of the digital future. Digital Realty Trust, ticker symbol D, owns and operates massive data centers. Every text you send and every video you stream depends on these facilities. Every application of artificial intelligence requires massive computing power from these machines. The demand for data center capacity is growing exponentially every single year. The customers are giants like Microsoft, Google, and major financial institutions. These tenants sign leases for 10 or 20 years because moving equipment is too risky. This company is the truest play on the growth of the digital economy. The dividend growth has been steady, and analysts expect this to accelerate with the AI boom. Now, imagine you divide your $10,000 equally among these three companies. In the first year, you would earn about $412 in dividends. If you reinvest every single dividend and let the companies grow, the numbers change fast. After 10 years, your portfolio value could grow to nearly $40,000. After 20 years, the portfolio value could exceed $100,000. This single investment could generate over $5,000 a year in passive income. This is exactly how wealthy families have stayed wealthy for generations. They buy quality assets, hold them forever, and let compounding do the heavy lifting. But this strategy requires you to become indifferent to short-term price movements. Our brains are wired to feel the pain of losses more intensely than the pleasure of gains. This is called loss aversion, and it is why most individual investors fail. They sell at the bottom because the pain becomes unbearable, and they miss the recovery. The antidote is having absolute clarity about the physical land that you own. You own the infrastructure under grocery stores, warehouses, and data centers. These things are essential to modern life and will remain essential for decades. The first $1 million is the hardest because your contributions do the work. But once your portfolio reaches a tipping point, the money starts working for you. At that point, your assets can grow more in 1 year than you earn at your job. Open a brokerage account at a reputable firm like Fidelity or Vanguard today. Set up an automatic investment for whatever amount you can sustainably commit to. Whether it is $100 or $500, consistency is the key. Split those investments among these three pillars of the modern economy. One for stability, one for logistics growth, and one for the digital revolution. Set it and forget it, so you can focus on your career and your family. Do not check the prices every day, and do not listen to the noise on television. Just keep adding, keep reinvesting, and keep holding for the long term. In 20 years, you will look back at this decision as your best financial move. Real wealth is not about winning the lottery or finding a lucky stock. It is about owning high-quality assets that pay you while you sleep. That is the boring but proven path to a secure future.